Welcome to the Broken Pie Chart Podcast, episode 207, or 207 for the long version. I'm Derek Moore, your host. With me is my always semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, how you doing today?
I'm doing great, Derek. Happy to be here. Number 207. That's awesome. It's great stuff.
So, all right, we're going to get into a couple things. First, the Super Bowl is coming up, and by the time people hear this, they might hear it before. The game's in the evening, so they might hear it before. You've heard the term fair weather fan, right?
I have heard that.
And you want to tell our audience what it means?
Oh, yeah. I mean, like, it's somebody that, likes a team. When the team is doing well, they kind of pick up on it. And let me use an example. All of a sudden now there's a lot of Philadelphia Eagle fans coming out of the woodwork, in my opinion. And I would say they are fair weather fans, whereas guys like you and I, who have been tried and true Giant fans through the last, not this year, but the previous 5 or 6 years, we were awful. We are not fair weather fans. How's that for an example?
Yeah, no, that's a good one. And it ties in well because there is something called the AAII. That's the American Association of Individual Investors, and they run sentiment polls. We've actually talked about this before. And I think there's some fair weather fans in there. And it really should be no surprise. But after 44 consecutive weeks where bears are greater than the bulls, and that was a record, this according to Charlie Bilello, and he put out a Y charts thing. When you look at net sentiment, so that's bulls minus bears, it's at the highest level, it looks like, since maybe January of no surprise, January of 22, probably. So what does this mean? It means that all of a sudden they're surveying individual investors and they're like, yeah, no, we're bullish. We're bullish. The market was down 25% at one point, a little bit over 25% on a price basis. January 22 to around, it was right around 4,800, a little bit less, to 3,580. Jay, these are fair weather fans, but it's no surprise. Like, people want to buy when the market's up. And when the market's down, they start to sell. And later we'll talk about the ramifications of that. But this is like textbook fair weather fans and sentiment, right?
But look, but this shouldn't surprise you. You're a market expert. You understand that sentiment and psychology of the market are closely linked. And when things start to look good in the market, people become optimists if they're trading, right, and investing. And, fundamentally, it's been some very interesting data that has come out in the last, let's just say, week and a half, right, between the Fed meeting and that really strong jobs report. And, like, all of a sudden, maybe people are getting a little more like, oh, I don't, like, things aren't as bad. But really, has anything really changed, Derek? Like, the Fed, Powell spoke a couple times in the last, I'll say, 10 days or so, and he said the same thing. We have more to go. The risk is, easing too soon, right? But yet the market seems to be, a little bit of a self-fulfilling prophecy at this point. And so, yeah, I'm with you that all of a sudden things don't look as gloomy to the average individual. And so I can see how they're a little more, optimistic because it's price driven. And we've had a really strong start to the year.
When I look at this too, and I think about, imagine if all you did was watch CNBC. And I'm not sure that CNBC helps a lot of people, because what I see these days, and I see it all the time, is you have somebody goes on there and they give the same talking points, and then somebody else gets those talking points from that person, and it becomes a circular argument. But there were people who went on CNBC at the beginning of, January of 22, and they said, the market's too high. The market's overvalued. And guess what? It probably was. In fact, we know it was. And the market corrected that.
At this point, we know it was.
Yeah, well, at this point,
right.
Yeah, sure. But then, of course, we also had people come on in October of 22 when the market was below 3,600 and say, you know what, I don't know, I need to wait till it goes a little bit lower and things become cheaper. And there's still people, and now the market, it's off 4,200. We never quite got through there yet. It's down below 4,100 again. But now I hear people again saying, I'm waiting for the market to get a little bit cheaper. The market was cheaper. It was cheaper And so you didn't buy then, and you're like, oh no, this time if it goes down, this time I'll buy if it goes back to that level. The first time, no. And maybe things have changed. But I got to be honest, like the market goes where it goes. And, this sentiment thing is just, like you said, Jay, we see it again and again. That's why people were in cash in 2008, right?
Yeah, and look, by the way, this is like you sound a little, upset, Derek. Like it's not often I hear this tone in your voice. Like you're mad. Like, hey, you're still in cash. I'm mad at you for that. Like, when are you gonna like? Look, what is the thing that you and I always tell people, right? We say, look, if you're gonna decide to go to cash, define your entry point, right? Okay, fine. You feel you've hit a point where you need to sell and go to cash, then great. Tell me when it is you're going to rebuy. And if you can't answer that question, you shouldn't be going to cash, right? You need to know the exit and the entry together, right? Just like when you buy a stock, you should know where you're willing to sell it or start to take some profits. Like just a little bit of discipline in your thought and remove the emotion. And next thing you know, you can actually have a disciplined approach. And you may not be right, but at least you have, an idea and you could take emotion out of it. It's one of the most important things when it comes to investing is remove emotion from your investing plan. uh, Look, I'm going to steal a quote from my book, right, which was, have you ever said to yourself after you made a decision, geez, I wish I was a little more emotional when I made that decision? No, and definitely not with investing. So, look, I think you just want people to have a plan and stick to it, right? I think that's what you're talking about here, Derek. And going to cash is hard. You could miss out just as much on the way up that you might have avoided on the way down. So it's one of those things that just have your parameters set.
By the way, Jay, I will say that was, of course, a quote from your book, Buy and Hedge. What a great Valentine's Day gift to get
Yeah,
available on Amazon.
that's true. It's my highest recommended Valentine's Day gift. Find it on Amazon. Buy and Hedge, the 5 iron rules for investing over the long term. It's a wonderful gift.
There you go. And the nice thing is, it's not
And by
like
the way,
yeah, go ahead.
I was going to say you should pair it with this other wonderful book called The Broken Pie Chart. I
Yes.
believe also available on Amazon.
Yeah, and the nice thing is too, if you give it to your wife or your significant other as a Valentine's Day present, and they throw it back at you. Luckily, it's not War and Peace size. Both of our books are a good size, readable size, I would say. But it's not going to hurt you too much if you get thrown at you.
If you would like to talk finance on your romantic date for Valentine's Day, it's a perfect book to stimulate your thoughts. Exactly.
Nice. All right, I'll put a link to those in the show notes as always. The interesting thing, Jay, is it's not only the individual investors. There's the NAAIM, which I'm going to take a guess. I'm not, National Association Active Investment Managers. That's
Investment managers.
maybe
Yeah, I think that's right.
that sort
Or,
of sits.
yeah,
Charlie,
something with investment manager.
yeah, we'll go with that. I'm sure it's a fine organization. So Charlie Bolello put this out as well, and this is the equity exposure. So I believe this is the highest level of equity exposure since January of 22. And the lowest, I think, was, the low is probably around the same time. The prior low is March of 20. And what's interesting here is that you probably have, active managers, and they could be serving pension funds, they could be serving, you have, investment advisors. And some of this could be, all right, well, people are getting more comfortable with having equity exposure, so they're letting their managers do that. I don't know. I mean, it's just seems like one of these, now that the market's going up, people are buying, right, Jay?
And maybe, Derek, it's the other way around, right? People are buying, so the market's going up, right? I'm not sure if this is the dog wagging the tail or the tail wagging the dog in this particular data point. But yeah, we shouldn't be surprised as the market is kind of pushing up to these, what do we got? The highest levels since August of 2022. And we had that nice bear market rally. It turned out to be a false rally or a rally that didn't hold. So we were back up to those levels. Yeah, so someone's buying to push it up there. I'm not really surprised that folks are starting to rotate back into stocks, especially with the action in the market. So I don't know which one caused the other one. Maybe it's kind of a little bit of a repeating circle there, right? Market's up, people buy, that pushes the market up, right? I'm not surprised by this data point. And that number, by the way, Derek, is what, around 85% of equity exposure, right? So not a lot of leverage. You can have more than 100% equity exposure, but this number we have now at 85% tells you there's still probably, I don't know if they're in bonds or cash with the other 15% or alternatives, but yeah, that's kind of the range that we're in.
You asked the question, is it people buying that's moving the market up, or are they buying because the market? I always remember back in our TD Ameritrade days, I had Ralph Akinpur on as a guest, the famous technician. And he was telling a story where I think it was one of the major news networks. There was some market turmoil, and I think they had called him and they asked if he'd come on and explain it. And I think they wanted to know what he would say. And I'm paraphrasing now. It's there are more sellers than buyers, and I don't know if they called him to have him on that day, because that wasn't a good explanation. But yeah, I mean, if there are
Oh,
more
they wanted
buyers
more
than
than that.
sellers, the markets go up. It's a voting machine. It's supply and demand. So
It's not the first time you've pulled that one out, by the way. You do say that from time to time.
yeah, when people ask me, I'm like, I don't know, more buyers than sellers. It is certainly, we got over any year that we have a bear market. There's also a lot of tax selling. And so we could have seen, although, even the end of the year, we closed near the lows for the quarter, but we didn't make new lows. But you would think that most people have tax harvested and sold. So I don't know, maybe that's part of it too. But Jay, you've always made the point that even just missing, like trying to time the market, trying to be tactical, it can cause you some trouble. And you recently updated some of the research you did about over a 20-year period, over a 10-year period. If you just missed, what was it, Jay, the 2 best days of the year? I want to talk us through this and kind of what you found in when you ran the updates.
Yeah. So, the study was meant to explain why staying invested is really important, right? And timing the market is really hard to do. And if you had missed the best 2 years of any year, the difference in your returns. And going back 20 years to 2003, just staying invested in the market, you would have gone up about 245% over that 20-year period. But if you had just missed the best 2 days, like if you're invested, but you take out the best 2 days, your returns over that 20-year period are minus 15%. So that is a very large swing that takes you not only from, less positive, but it actually brings you negative. And but listen, maybe not everybody thinks about it over a 20-year period. What about a 10-year period, right? So we also looked at that. Same example, take out the best 2 days of the last 10 years. The S&P was up about 108%, but a portfolio that missed the best 2 days is only up 10%. So you have a significant underperformance. And by the way, it's just not one or two of these days. Like it's consistently, widening over time that when you miss those best 2 days, that that you have this underperformance. And I always, ask folks, guess when the best 2 days usually are, right? Usually right after the worst 2 days, right? And so just when everybody is in the middle of doing their panic selling, right? And you go, wow, market's going to have a down 4, down 5% day. People are running for the hills and there's capitulation and there's fear and they're out. The snapback usually comes the day after, and investors that miss that end up having this dramatic lag, right? I mean, we could go back and do this study that if you sold on that worst day, what your performance would be just skipping the very next day, one single day. And again, you would also find a dramatic lag in the performance here. So, it's just meant to help people understand that, timing the market is really tough and just you don't know when the best 2 days. Derek, do you know when the best 2 days of the year are going to be?
Well, I used to joke when I would be in front of large crowds talking about investing. I say, okay, grab your pen. I'm going to tell you you know, here's when you want to exactly exit the market. Here's the best time to place your trades, and everyone's heads would go down. They'd start to write, and I'm like, no, how would I know that? I don't know that, Jay. I don't. There's no way to know it.
That's a good trick. That's a good
So
trick. Oh, write
this
it down.
study. This study, by the way, so that does not include dividends, right? So we're just using a price return.
Oh yeah, it's not dividends, just straight up price change of the SPY. Actually, I think the ETF SPY. Yes.
I'll have to go back and look in your book too. Here we're referring to Buy and Hedge again, the book, and this wasn't a planned. We didn't even plan on talking about these, but I seem to remember in one of the chapters, didn't you have a table with the single best days and the single worst days? And I remember they were sort of all clustered around each other, right?
They are. That's exactly right. They are clustered together. And so if you're looking for a book to read during your President's Day off on the 20th of February, also a great read. If you haven't finished it by Valentine's Day, take the time, continue to read the book, and you can see the data that outlines when the best days of the year and the worst days have happened in the market. And they are absolutely clustered together. Yes.
Yeah. I mean, I'm sort of, we're joking around about it, but that's what I remember. And it's one of those, and we saw it in March of 20 too. I mean, we had some of those massive down days, and then you had massive up days.
I mean, you saw it in 08, right? You saw it in 08, 09. You saw it in 2020. I mean, heck, Derek, I think we had a day where the market went up 10% in a single day, right? Right after the market had dropped like 13. Like there were some wild days there. And if you were just out because you just couldn't take it anymore and you missed those big up days, it's a hard thing to make up when you miss the big days.
Yeah, I mean, it's one of the reasons why we say the core thing we do is just being invested and being hedged or having buffers. If anyone who wants to, learn more about that, derek.moore@zegafinancial.com, derek.moore, at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly. All right, Jay, let's switch to a little bit of the economic side. And what I'm seeing is there's some mixed signals on inflation. I'll give you an example. There's the Atlanta Fed tracks wages, or wage growth, I should say. And while wage growth on a year-over-year basis, meaning what was it in January or December, and then you go back a year, you compare it to that number, 7.3% is the year-over-year wage growth for job switchers. So people who have switched jobs and went somewhere else to work. It's only 5.4%. I shouldn't say only. That's a misnomer there, but it's lower. It's 5.4% on a year-over-year basis for job stayers. I'll say two things about this. The rate of change has come down off the highs, but that is still higher. And the spread between a job switcher and a job stayer is still pretty wide. Like, Jay, just looking at this, I'm saying in a bad labor market, people don't leave their jobs because, hey, I have a job. This is great. But people still, it seems like, are able to switch, and they're making more while switching. I don't know if you read anything into this, but it's a mixed message for me.
Well, it is interesting because one of the fears about inflation is that it makes its way into wages, and wage inflation is very sticky, right? And so I think this is definitely a concern of the Feds that they're when I say the Feds, I don't mean like the FBI. I mean the Federal Reserve, and I think that while this is the widest that we've seen in the last 25 years, right, between the switchers and the stayers, they are both also at their 25-year high. I mean, you're right. They came off their maybe what do you think that was 2 months ago when it was at the highest? It's one of those things, Derek, that I think the availability of jobs, if you can switch, it's happening, and you're giving yourself a bigger raise than staying at your job. But I think your wages are keeping up with inflation anyway, and you've got a 5.4% increase is where we landed this last month. And so, my 2 cents on this is I think it's bad for inflation that this is going up. I also think, though, it does signal the economy is still healthy because people are switching and getting paid more, which is why the jobs number was so confusing last week and blew away everybody's expectations. So wait, do we or do we not have a strong labor market? It's clearly strong. Or do we not have inflation? We clearly have inflation in wages. So I think, Derek, boil all that up. It's this lacks, volume, and, is it 5 people that switched or 500,000 that switched? I don't know that data point on this, but to me, it's exactly what the Fed is trying to bring down. And I think hence why the market reacted so negatively to that jobs market, because it means the Fed probably has more work to do to slow down growth in the economy.
Well, speaking of slowing down, the U.S. Atlanta Federal Federal Reserve Bank of Atlanta. Leisure and hospitality, while in aggregate, it's off its highs, 7.2% year over year wage growth in that sector. And Jay, that is the highest it's been going back to 97. And it's not going down, it's going up. So I don't know, is this maybe a reflection of the fact that hospitality, and that's probably what, boat captains, hot air balloon captains, servers, hotel
It's probably
workers.
more like servers and
Yeah.
restaurant workers, type of stuff. Yeah, yeah. The hot air balloon captain, that guy, we want him to feel really good about his wages. We don't want him going to work angry, right?
I've never been in a hot air balloon. Have you?
Oh, I have not.
All
But
right.
I'd want the guy that was driving it to be really happy about his compensation.
Yeah, you do.
So, but your point, in all seriousness, right? Like this has hit a new high in the last 25 years, and I mean, it's accelerating, right? It looks like it's going up. So, the point of this one, Derek, is look, there's sectors within this job market that are absolutely showing wage increase. I'd argue this is probably, for the most part, on the lower end of the salary curve, right? This isn't software engineers. This isn't, I'm going to say financial experts. It's not lawyers. It's not doctors. It's hospitality and leisure.
Yeah, I think that's right, which is problematic in its own way, because when you think about when the stimulus checks went out, what happened there was the lowest quartile or really went up the most, not only in wage growth, but also in savings as well. And look, maybe those people did need an increase. They haven't been growing a lot, but yeah, this is a mixed signal to me, and this seems to under the surface be problematic for the Fed. And I'm smiling as I say this, that Powell wants you to be out of a job and the market to crash. That's what Powell wants, and I'm saying that with all sarcasm. This is not going his way, right?
Nope. He's definitely got some work to do when you look at data points like that. Yep, absolutely.
Leave it to you and I to predict where markets are going to be. Anyone can go back and listen to last year's December episode where we made our predictions for 2022, and boy, we were wrong. That's why we buy and we hedge. We don't try and time markets. But there's some new data out. This is from I think this is Bloomberg and Stifel, if I'm reading the thing right. Somebody put this on Twitter, and it's the inflation adjusted S&P 12 months before and 18 months after inflation peaks. And the quick thing is that after inflation peaks, markets historically, on average, have bottomed in month 7 and take off. So we peaked on the CPI, at least so far. We don't know. We'll know afterwards. But it seems like, year over year, we were 9.1% in June of 22. And Jay, the market's bottomed, what's that, September, October. We're higher than we were then, but month 7 would be January of 23. So is this saying that we're going to take off from here, according to this, or we've already taken off and we're just early? I don't know.
Yeah, so let me make sure I get the data point clear, right? So based off of this study, and it looks like they've identified 15 major inflation peaks using CPI. And historically, the average bottom of the market was 7 months later, right? So this time it was June of 2022. And you're saying, this chart is saying, I know it's not you, Derek, this information, this research is saying, hey, we should see a bottom in January 2023. Well, clearly, we're not at the bottom. We are off the bottoms of the market, right? We bottomed out. When was that? I'll say October, right? Early October, late September. And so that was definitely not, 7 months following June. So with these 15 data points, is this one just, on the early side of it? Or have we yet to see the bottom because we're 7 months now? We've yet to see the bottom and we may hit a new low. I'm not sure, right? We're still kind of in that range here, Derek. I don't, like you said, don't look for us to predict where the market's going. But there's really two scenarios, and this isn't very helpful, but either we have bottomed or we have yet to bottom. I guess I'm going to be right on one of those. And my point being that this is so. If this was the bottom, it was an early bottom, right? When I take a look at it, uh, uh, at the way that they're describing their methodology here when they do this, that would have been an early bottom. So, but we're clearly not there now. So it would be a late bottom if it doesn't if we do have another retracement. I don't know. Like if the way to interpret this data is, it's not very predictive to me, but it's interesting. Like I don't. How do we use this one, right? Except for the fact that, or was it early, or is it still about to come? I'm not sure. And I think by the data that you have put together here, and you're talking about wage growth, maybe we haven't even topped out on CPI, although that would be quite the surprise if we haven't topped out on inflation, right? Would you agree that seems to be the case? CPI inflation is definitely slowed.
Yeah, I mean, so the numbers get harder to make a new high, barring a really strong push higher in inflation. You're looking at, so the January numbers, which will be out, is it next week? I think it's next week. January
Yeah,
numbers,
yeah,
yeah.
right when this comes out, right? Yep,
So
CPI is coming.
January 31st, what's the basket of goods in the CPI? And then they take a look at January 31st of the year prior, and they do a year over year. The problem with, if you were saying, hey, I think inflation is going to make another high, it's going to be above 9.1%. The estimates now are probably 6.2, 6.3 year over year, somewhere around there, give or take. So the math just gets harder because that basket, if the basket was 200 and it goes to 300, to give you an example. Well, now, to get that same rate of change, it would have to go up a lot more. So if it goes to 350, it's not going to be the same. So yeah, I don't know. But we're all guilty.
Yeah, go ahead. I was going to do an eggs analogy, but I think you made the point clear about how inflation, stays high but doesn't increase. Maybe I say prices can stay high, but that doesn't mean the rate of change. It's a rate of change versus the actual price, right? So just because inflation.
And this is the most misunderstood thing with inflation. It's that inflation going down does not mean we're going to go back to the prices we had prior to this run up. It just means that they're going to stop going up. I mean, this inflation is booked in. I was just going to say too. I mean, honestly, maybe we're all guilty of this in financial industry where we get a bunch of data, we see something, and then it gets circulated around, and that's the thing for a while. Remember, at the end of the year, it was the elections, which, by the way, so far has been right. That market is up in the year three. We're only through the first month, but I don't know. I don't really have much else to comment on this, Jay. Do you?
No, like like that's a fun data point to have, and nothing. I don't think there's any way you work that in to our investment and our investment process. And actually, Derek, I would almost say, when you look at a lot of this data, right, we're all trying to help people get an understanding of kind of the swirlings underneath the market that may or may not push it up. Everyone's looking for kind of insight as to what is going to happen going forward. And the market, I always like to say, will surprise the most people, right? It just has a habit of doing that, and the opposite of what the everybody thinks of happening will happen. And so, while this is all information to kind of give us a general gist of which way the currents are moving, I mean, it's hard to make predictions out of these.
Yeah, I mean, I would agree. I think but you made the point before, and I think, and from memory and from looking at history, markets tend to bottom first, then it's earnings, and then the economy. And it doesn't have to be that way in the future. It doesn't have to be that way this time. But that's what we've seen in the past. Like markets are, they have the mind of their own. Like they have a sense for what's coming. And a lot of times, like look at March of '09 was the bottom. The economy didn't get out of a recession until after that, and earnings didn't bottom until after that, but the market did. And so, whether this was the bottom happened already or whether there's a bottom yet to come, I mean, who knows? Um, but I think you made that point. It's a very good point, Jay.
All right.
All right. A couple other quick hits here. just this is interesting stuff to me. I watch this stuff on the periphery, and I saw a chart. It's durable goods inventories divided by sales ratio. So it's kind of like you want this to be on the lower end because it means you're turning your inventory over. And by the way, your inventories could be low as well because you have no inventory. So it's sort of, but durable goods over sales is higher now. It's the highest it's been probably since, I don't know, March. I'm going to say like June of 2020, maybe. I don't know, Jay, if this is anything, but
Well, I think it's something, right? Yeah, I mean, look, the one, so it's a ratio. So either, it's two data points and the relationship between the two of them. So you're right. Sales could just be down and inventories could be the same, or sales could be the same and inventories can be up, right? To cause this, numerator denominator thing to happen. What I would say that I like about this data point, Derek, is that, you and I have talked about the cause of inflation for over a year now has been, maybe close to 2 years, has been around supply, right? And I think inventories are a decent proxy for supply, right? And so if, I guess I would ask the question from this, or I would maybe make the statement from this, that the supply chain problems seem to be working themselves out, right? You may not, you know, you may have to pay more than you did a few years ago, but it's there if you want to get it. And by it could be, anything. So I feel like that is what I read out of this, that, the thing that drove a lot of the inflation that you and I have said drove a lot of the inflation, right? It being a supply driven inflation cycle, not a demand driven inflation cycle. I mean, this is like a data point that helps me think that is, that's done.
if you need a toaster, they got toasters. That's what this is telling me. Yeah.
You got a toaster. Yeah. Yeah, you need a refrigerator, you get a refrigerator. Listen, you may be paying more because now everything's more expensive. You need a car, you can get a car. There was a period of time you couldn't get a new car. You can get a new car now. Still may be waiting a little bit, but it's not like it was, 6, 9 months ago.
You may not remember this, but I probably had a chart that was very similar at the beginning of 2022. And we said it could be two things. And we looked at this when the sales ratios was really, the inventories over sales was really low. One is that companies are going to have to keep ordering to refill their inventories. And that's a very bullish thing. Well, it turned out 2022 was a bearish year. But to your point, I mean, you never really, there's sometimes stuff that's on the periphery below this. You and I are not analysts covering durable goods. If I had an analyst, from a major investment bank, they'd probably give us much more insight that you and I are giving. But one thing I do look at too is this is another one: lumber and other construction materials inventories over sales ratio. This one is getting close to the peak of the COVID recession, and I don't know. This one seems like it's easy to explain that if houses aren't moving, maybe they're slowing down their construction. I don't know. Maybe that's the case, right?
Yeah, right. I mean, if people are, I mean, I think we've heard a lot of the stories about people that contracted for a house and just walked away and said, nope, I don't want to do it now, right? It's like people are like, money's been a little harder. People maybe a little more concerned. And then, so I think that is one of the things. And look, let's face it, if there is one thing the Fed can really impact out of the gate, it's the housing market, right? We know that when they cut rates in 2020, it caused this huge real estate boom, right? Everybody's house today is worth more than it was 3 years ago. And so and by the way, your rents have gone up too, right? So all of that stuff happened when they cut rates. And now as rates come back up, they've slowed this and then this ripples out into other sectors. I mean, do you remember lumber was one of the leading supply constrained commodities that drove up inflation, right? I'm going to put you on the spot, Derek. Do you know the price of lumber today? Sorry, coming off the script, right? But versus what it was in 2020 when we were talking about it, it's down, right? Dramatically. Am I fair? Are you gonna wing it for me? You gonna try and get it?
Well, I actually know about where it was. I think it was around 12 or 1300.
Right.
And all right. So now I'm gonna look it up because I don't know what it is today, which shows you that's not a big deal. It's $4.99. Random length lumber futures. Let me pull it up. Yeah,
Okay. I know you'd be able to pull up lumber futures, and it didn't even take you 15 seconds. So congrats. I'm not surprised.
1670 was the high. I was off by a little bit in May of 2021. Yeah.
And that was a supply thing, right? So even though this whole lumber divided by sales ratio is high, right? The price is not high any longer, right? So, just food for thought there, that, the supply situation is definitely working itself out and demand could be back or pulling back or, heck, just sales are down, right? So, like, I don't know, Derek, I think, again, I go back to the whole, if it was supply driven inflation, this kind of a data point tells me supply is available. And look, no surprise if the real estate market or the construction market is having a pullback with all of the impact that the Fed has tried to deliver with raising rates.
Two more quick things too, and I think this speaks to maybe the Fed has gone too far, and they're not going to go any further with rates. And then I'll kind of bring us back to what the market says is going to happen. Would it surprise you, Jay, if I told you that in billions of dollars, that our last reading, $552 billion, is personal savings for the US on a seasonally adjusted basis, not inflation adjusted? Would it surprise you if I told you that is the lowest it's been since Q3 of 2008?
Absolutely. That would seem low to me.
It is. And to put this in perspective, at one point the savings rate was 4.8 trillion versus 552
Yeah.
billion. I
I
mean,
remember the
which goes back to the
T
whole
was in there
idea.
when we talked about this,
Yeah, with the T.
months ago. Yeah.
So this tells me that maybe inflation is taking more of an impact on people than everyone even understands just looking at the savings rate. It seems like people are spending down their savings, and it seems like they've spent down the stimulus checks, the overages, all that stuff that happened, during the pandemic. There's not too much to say on this, Jay, but just I was surprised at that. And this tells me that all this stuff, the economy, remember, one of my theories is we've already been in a recession and it's been a small one. Um, this tells me, rates shouldn't go up enough anymore. The Fed's done enough. But the market, Jay, is now implying the federal funds terminal rate, which means the highest that the rate will go, 5.15%. I mean, there's all these different dichotomies and things that really don't make sense if one is here and the other's here. But Jay, this is, I think, one of those things where people could get wrong. Everyone thinks inflation's over. Everyone thinks the Fed is only going to raise another quarter. Fed's saying something different. The market's saying something different. And then we have all these data points that tell us other things. I don't know. Flip a coin, right?
Well, let's comment on the savings for a minute, right? Like, if savings are dramatically down, like they're 10% of what they were, at the peak of the I'll say the bailouts, right? That will obviously push down demand, right? Like, there is less money to be spent. I actually think I heard that the money supply has actually shrunk for the first time in 50 years or some number like that. So I wish I had that at my fingertips. I think you probably know it, but uh, if the money supply is down, if people's savings are lower, then they will spend less. And that's the thing that you and I had always talked about, that inflation is going to naturally fix itself, right? And the Fed can't impact as much as they think they can, or maybe as much as they want to, a supply driven inflation cycle. And now you're going to have demand coming down on top of supply, inventories being high, right? That's not a great combination, right? When the economic activity can't take care of the inventories that are there, and you could actually have a deflationary environment with this, right, Derek? Like, this could flip so fast the other way. Then what happens, right? Does the Fed have to pivot, right? So this is what the market is kind of projecting, right? There's a lot of folks that are saying, look, even though the terminal rate is projected at over 5% for the Fed funds rate, It's not going to stay there. And the proof is, I'm not saying that, the market is saying that when you look at how strongly the yield curve is inverted, when, the 10-year is at, let me just get a quick little number here of where the 10-year finished today, right? 3.74. The 5-year at 3.92. That's significantly lower than where the Fed wants to bring the markets. Somebody's wrong. We've all heard this, is that the Fed is at the market. And it's hard to fight the Fed here. And they've told you they're going to keep rates up. The market's not believing it. And data points like the amount of money in savings accounts are one of the reasons why the market doesn't believe it.
It is interesting too, by the way, that even if I go back, let me pick a random date here. Q1 of 2018, 1.097 trillion. So it's just interesting. I'm going to spend a little time on this and see, because to me, this tells me a lot of things. I'll report back on this, but let's switch to, I don't know if we want to give our Super Bowl predictions. Do you have a sense there, or actually you have a show that you wanted to recommend, right?
Oh, yes, if we want to go there, I think I've been watching The Last of Us on HBO. Not bad, kind of a new take on an apocalyptic humanity, right? But the Super Bowl, list, by the time people listen to this, it's already over. So I actually, unfortunately, while I'm not a fan of the Eagles, I think they're just way too strong and they're going to win. And I'm definitely not a fan of the Eagles, and I hope they lose 99-0. But just watching them go through the playoffs with the power that they did, that's probably not going to happen, and they're probably going to win.
Now, granted, they played the Giants, and they played San Francisco, who lost not one, but all of their quarterbacks after like the first drive.
Yeah, but look, it's how they tore through those defenses is what was most impressive to me.
Yeah, I think you make an argument for the Eagles. You can make an argument for the Chiefs. We'll see.
I know.
The Last of Us, though.
Kansas City 99-0. That's what I'm hoping for.
So is it a series, The Last of Us, or is it each?
The Last of Us. Yeah, it's an HBO series. Yep. So I think they've had 4. By the time you hear this, it'll be 5 episodes will have been out. It's good. It's it's good. Like, I'm going to give it like a 7.5.
I'm interested, and what your description reminds me of a book I read called The Road by Cormac McCarthy, and same thing, kind of the survival, post-apocalyptic survival about a father and son. So it's a really, really good book. Obviously, it's fiction. I shouldn't say obviously, but it's fiction. That.
Well, I don't think we have an apocalypse right now, so yeah, obviously fiction. Gotcha.
Yeah, I don't know. And I've been watching the thing on Apple TV Plus with Harrison Ford, Jason Segel. What's it called? Shrinker, right? God, I came with a recommendation here. I can't even think of the actual name.
I have not seen it yet, but I know it's out there. Yep,
Shrinking,
for sure.
Shrinking. That's what it is. So Jason Segel, Harrison Ford, and Harrison Ford's actually, he's good in this. Like he sort of plays.
Why are you surprised? Do you think Indiana Jones isn't great? You think Han Solo's not? What are you talking about? Who doesn't love Harrison?
It's a different role for him, though. It's like, he's sort of self-deprecating humor, and he's kind of being funny. So I'm about 5 episodes through right now. It's on Apple TV Plus. So I'll go with that for this week. That's all right, Jay. Well, I think if more buyers and sellers, the market will go up next week. If there's more sellers than buyers, the market goes down. That's where I'm ending this. Jay, thanks again for coming on. And for everyone else, hope you enjoyed the Super Bowl, and we'll talk to you soon. Bye.